Hello, everybody. I hope you are fine wherever you are. I welcome you to this Acca FA1, FA2 hybrid week 3 class on the cash book, sales, and receivables. Here we are going to touch the further aspect of these things because in our previous week lecture we discussed again about them. Okay, so here we just want to add some little flesh to ensure that everything has got covered. Okay, to ensure everything has been dealt with. All right, as for my name, I'm Mr. James Kulu, the Acca tutor at OBU Acca BSc registered mentor. If you want to get in touch with me, this is my number. +263 774 596 368. You can also email me at jamtimkulu@gmail.com. Alright, but don't forget to visit our website at, let me just write this down. Okay, our website is just www.transkyconsulting.co.zw. Okay, that's how you're gonna get in touch with us for any further or future business which you think we can both enter into. Right? Okay. Now, the objectives of this lecture, we just only have got two objectives which we need to meet by the end of this lecture. The first one is to get more insight into what a cash book is and how it is completed. Second, to explore deeper into sales transactions and the receivables ledger, including an understanding of the documentation involved. Alright, now the cash book. It is the cash account of the business and is where bank account receipts and payments are recorded. So whenever we have bank transaction like bank payments or receipts from customers, all those transactions are reflected in the cash book. All right, in a simple T account it would look like this. So you can see this is our cash book, ladies and gentlemen. This is our cash book. Okay, a typical cash book is like this one. You still remember when we talked about the books of original entry or prime entry, the cash book was also identified as one of them. It is both a book of original entry as well as book of double entry. Why? Because the cash book is actually what it is even in the general ledger. That's how it will be looking like. Okay, so it is part of the general ledger. Okay, because the general ledger, that's where the double entry is. That's where the double entry bookkeeping system is. So we have got like any other T account or like any other account, we've got the debit side and the credit side. The debit is for the receipts and the credit is for the payments. All right, and you can see here because cash is an asset, we are going to have a balance brought down of any amount, okay, on the debit side. The balance brought down or the opening balance would be on the debit side, okay, and then we have to enter all the transactions which reflect some receipts from customers, for example cash sales here, and then received from Soko D, received from Aberoke, and some cash sale here. Okay, all these were money entering into the business. So money coming is recorded on the debit side. All right, but money leaving is recorded on the credit side. This is leaving, this is coming. Okay, so that's money coming is recorded on the debit side, but money leaving is recorded on the credit side of the cash book. But you can see we just do the usual processes of balancing the accounts. Okay, the debit side in this case was having the large amount, so these are the totals of the debit side, so they have to appear on both sides. Okay, then here there was a deficit of this amount, which we call the balance CD, because we wanted to ensure the gap is filled, and the gap is filled by this balance CD. However, the ultimate balance of the cash book would be this, because we have got money. We still have got money, so we are going to have a balance BD, which is on the debit side again as our opening balance for the next financial period. Are we together there? Please don't get lost or don't be confused with this. Okay, now I want you to note something here. All right, this description for cash sales was just cash sales of, let's say, 300, and there were also cash sales of $99 on the debit side. This means that these were sales which were maybe bought by people without accounts with us, without credit accounts with us, or without some credit relationship with us. Okay, so they came into the shop and then they bought their things and leave. All right, but people like Soko D or Abero K, these ones have got accounts with us. They are our credit card customers. So whenever they make their payments, we would be recording everything in a separate personal account for them. Okay, we will be recording everything, and we will be updating their accounts as we go. So this is why we have indicated that the cash was received from these guys. We had to write their names so that we also update their accounts as normal. All right. Similarly, on the payment side, there is a payment to Mr. Masamba. That payment was ideally given such type of description to ensure that when we be updating our records, we would be also updating his account. All right. So what it means in this case, by the end of the period, the cash book was showing that we are having money. We are having cash worth 1,248 is our closing balance. All right. But you can also see that this type of cash book lacks something. Lacks the required precision, because it signals that we have to make or to update the general ledger entries with to open every entry, whatever we want to record. Whenever we want to record transactions, we have to open a line for each entry, which is not actually good. Okay, we need a more efficient arrangement, which would then have to use. So this is the reason why we have got what is called an analyzed cash book. All right. And ladies and gentlemen, this is an analyzed cash book. You can see that the debit side now is still the same, the credit is still the same, but there are a lot of columns which are now appearing. Okay, there are now a lot of columns which have been included. All right, but the information is still the same. We still have got our opening balance of 1,600, and this is the same opening balance here. But you can see that we have a column for cash sales and for receivables, right? But the totals are still the same from the original cash book. Okay, this is the same information which was appearing on the original cash book, but we want now to ensure that where possible, certain transactions which pose or which have got similar characteristics should at least be merged to some extent. For example, the cash sales here and cash sales here, they have to be at least given a total figure here. All right, 300 plus 99, and then the receivables, they would also have to come to their total figures. Unfortunately, on the credit side, we didn't have transactions which could be made, but you can also see that there is some clarity here where if they were men, if these transactions, if there were a lot of transactions from cash purchases, there was no need for us to just having to have more entries being posted, but we just need the totals. As you can see here, all right, as you have seen here, these totals are actually very, very important. You will see as we go. All right. Now, from the above analyzed cash book, the following can be noted. Since the cash book is part of the double entry, the debit entries in the cash book are debits in the double entries bookkeeping system. Okay, what we are saying is that, like I have indicated earlier on, that the cash book is actually the cash account of the business. Therefore, the cash account in the receivables, in the general ledger, would be also showing the same information. All right, so the general ledger is actually represented by the cash book when it comes to cash and bank transactions. All right, so the debits are as they are appearing in the general ledger. This is actually what is happening there, but it doesn't mean that the these debits are actually corresponding to these credits. No, it doesn't work like that. Okay, the credit entries in support of these guys, the credit entries would be not these ones as you are seeing them, not these credit ones, but their corresponding credits would be something else. For example, the cash sale. When we make a cash sale, we debit cash, as you see here. Cash has been debited. Okay, it's on the debit side, but we credit sales. So the credit entry was actually the sale. So it is not here. It is not on this side. All right. Don't be confused there. Don't be confused there. The reason why is that it is so. It's because in the cash book we are recording cash only. We are recording cash. All right. In the cash book we are recording cash getting in the business and cash leaving out. All right. So when we make a sale, only cash is being received. When we make a sale on cash, we debit cash because we've received cash, but doesn't necessarily mean that cash was going out immediately. So this is why I'm saying that what's going on? All right, so this is why I'm saying that it doesn't mean that those debit side, those transactions on the debit are actually being represented or reflective of the transactions on the credit side. No, it doesn't work like that. All right, it doesn't work like that. Okay, so their corresponding credit entries for those items have not been. The entries card can be made from the total of each columns. So, for example, like for credit sales, for cash which has been received from credit from cash sales, all right, the corresponding credit entry would be credit sales. For the, remember here we had written there is cash sale. Okay, there is cash sale of 300 and then cash sale of 99, which all these have got a total of 399. So we are simply saying that this is, in this case, there was a debit entry of cash was debited with 399. Okay, but the corresponding credit entry was credit sales 399. So this is what this statement means. All right. As for the receivables, okay, the cash book was not also showing this entry. Why? Because the cash book only records the cash movement. All right. So what was recorded by the cash book in this case? Let me just try to erase a bit so that you see clearly. Okay. Let me just try to erase so that you see. Let me just remove the clutter. All right. Okay, as for the receivables, what was recorded was the amount which these customers paid. Okay, so they paid, Soko D paid 280 and Aberoke paid 503, and this total is what is going to be reflected. Okay, so we are going to say, all right, the cash book only wrote or recognized this entry, debit cash, okay, of 280 and also cash of 503. Okay, this was also another debit, but there is also a credit entry to the receivables account of 783. The receivables account were being credited. Why? Because they were being reduced. Customers have paid their account, so it had to be reduced. How do we reduce a receivable? You credit it. Why? Because a receivable is an asset. Remember, when we did the PL's acronym last week, we said that the first letters for the PLs, remember the PLs acronym. This acronym is going to be our trading passport throughout the Acca journey. Okay, please don't forget about this. We say that the first three letters of this word are increased by debiting. They are debited. They are debits by default. Okay, we said P is for purchases, E is for expenses, A is for assets, and we say that your work is just to identify if the item being spoken about is either a purchases, an expense, or an asset. For example, receivables. Receivables are assets. So, being assets, they are increased by debiting. But when a customer is paid, it means the receivable is being reduced. So, what is the double entry? What is the accounting effect? It is being credited. So when you want to reduce the asset, you credit it. When you want to increase the asset, you debit. Okay, what about an expense? When you want to increase an expense, you debit it. When you want to reduce the expense, you credit it. For purchases, the same way. You then go to the other side of the POs, the RLS. These ones are credits. They are increased by crediting. Okay, revenue, income, liabilities, share capital, they are all credits by default. They are increased by crediting. But when you want to reduce them, you debit. So to reduce them, you debit. So it's simple. Accounting is very simple, isn't it? Good. So let's go ahead. Now, in addition to the memoranda account of Soko T and Abiroke in the Receivables Ledger, in addition, the memoranda accounts of Soko T and Abiroke in the Receivables Ledger would have to be updated, and we talked about the Receivables Ledger. Okay, the Receivables Ledger is not the general ledger. I indicated that in the previous week. If you didn't get it, if you didn't get much of that, please just revisit that tutorial, okay, that video tutorial for week 2, so that you get acquainted with what is going on. When you're talking of the Receivables Ledger, this is another. It is not a full ledger, which is the general ledger, but it is another record that will assist you to keep accounts for each customer. Sometimes it is called a list of accounts, okay, a list of balances, or a list of accounts or personal accounts for our customers or our suppliers if it is a payables ledger. All right, we say that there is a GL, and also there are also these personal ledgers. For there is payables and also the receivables ledger. Okay, these ledgers, they are here. Okay, but there is also what is called books of original entry. Books of original entry. Okay, these are all books of primary entry. All right, so these guys, they feed the general ledger. They also feed these other ledgers. All right, but by the end of the day, the information, because in the general ledger there is what is called the payables account, payables control account, and there is also what is called receivables control account. So the total for the receivables should also be equal to the total of the receivables ledger account. The total of the receivables control account, which is found in the general ledger, should be equal to the total of the receivable balances of all receivables which are reported by this ledger. All right? But we also highlighted that the way the general ledger gets information from the books of original entry, it only takes total. But these ledgers, the payables ledger or the receivables ledger, whenever they take information from the books of original entry, they take line by line. Okay, so that's the difference. But we touched much on that in our previous lecture. So at the moment, please do just have a revisit of what we covered last week. Okay, if you find any challenge there, please don't hesitate to contact me. All right, I hope that I've done justice to those aspects. Let us just move on. Okay, let us move on. Okay, I'm looking for my pen. What's going on? Yes. All right. Similarly, credit entries have been recorded in the double entry system, but the corresponding debit entries for those items have not. Okay, the entries required can be made from the total of each column. Right, so you can see also that for the purchases, the 361 here, okay, the cash purchases, why we recorded? Because money was getting out of the business to procure purchases, okay, but you can see here that we do not have a corresponding debit for this. This is only the credit part of this transaction, but the debit is actually the debit purchases. All right, debit purchases and credit the credit cash. In this case, cash is being credited because it's left the business, right? But if it had been a transaction which is based on credit, then we were going to credit the supplier, okay, or the payable. All right. So in this case, for example, for Masamba, the payables was actually going to be credited. All right. So because it was okay, for this transaction, the Masamba transaction, okay, here we had previously procured goods on credit, okay? But this time we were now paying, all right? We were now paying. So there was a payable there. There was a payable. So we are now paying. So by paying, we are reducing a payable. I say that payables are liabilities. All right, liabilities by default have got credit balances. All right, so they are increased by crediting. Whenever you credit a payable, you will be increasing the payable. However, in this case, because we were making a payment, this is why we need the corresponding debit. The debit will be reducing the payable. All right, so we are going to debit the payables ledger control account. The idea is to reduce because we have paid. All right, so this is why the corresponding entry is going to be the debit payables ledger control account, and the credit was crediting cash because we were paying a payable. Okay, cash was leaving out to reduce a payable. All right, for wages, okay, we're making payment here for wages. All right, the 655 was meant to pay wages, so cash was leaving the business to pay wages, but the corresponding debit entry here is not found here. But we know that wages are expenses. Expenses are increased by debiting. Okay, this is why here we need to debit the wages. Tax is also an expense. That is why it is being debited here whenever we make a payment to those things. Okay. In addition, the memorandum account of Masamba in the payables ledger would also have to be updated. All right. Why do we need to update these memorandum accounts? Because the main purpose, the main logic of having the receivables, these memorandum accounts, the receivables or payables ledgers, they are sometimes called personal accounts. All right, we need to be able to manage these payables or receivables on an individual basis, so that whenever a customer inquires from us on how much they were owing us, or what was overdue or due for them to pay, we will be able to do it as quickly as possible. We'll be able to answer them. We'll be able to handle their queries in a quick time as possible. All right. So that's the idea of having these memorandum accounts by the side. All right. Now, sometimes we are involved in transactions with sales tax. All right. Sometimes these transactions will be having some sales tax connotations. Although we covered sales tax in our previous lectures, we may also benefit a lot from this discussion, okay, here, because sales tax is going to be resident throughout our course. So we just have to be very, very vigilant when it comes to taxation. So we still have the same information at hand here. The balance BD is 1,600 as usual, and we've got cash sales. All right, where we have got this that is an assumption that all sales tax, in this case, let's say it's 20%. Okay, that's our assumption, right? Tax is 20%. The sales tax rate is 20%. Okay, it's a bit high, but let us just assume the sales tax, the VAT tax was 20%. So here, when sales were made, Okay, the total sales, the total including cash, including tax, the gross sales were $300. All right, so how do we determine the sales tax? To determine the sales tax, if you are given the tax, a tax inclusive figure, you just have to say, for example, here the 300, you say 300 multiplied by 20 over 120, and you must get 50. All right, let me just use my calculator to verify. Alright, so I said 300 multiplied by 20 over 120, that's 50. Okay, so you can see that the sales tax figure is 50. And then for the remainder, the net figure, this is what is called the net. The net figure would be 300 minus 50, and you get 250. So simple, isn't it? Good. But one thing I would also want you to see is that the sales tax only occurred, or what is accounted by the cash book, in cash sales, not in credit sales. And you might also be worried and say, why is it so? Why are those amounts received from D, so-called D and K not being taxed? All right. I want you to pay careful attention here, because this is where most Acca students spend many years failing this paper because they don't want to listen. Please listen, and listen very carefully, because this is it's actually a rich example for every Acca examination. So please listen here. All right, we are saying that cash sales, these ones were actually very new transactions. Okay, tax is actually charged or harvested at the point of the transaction. Okay, when you start the transaction, that's when the tax is considered. So the cash book, like I said, only records transactions where cash was in movement. Not on credit, not for credit transactions. The cash book is not for credit transactions, but it might be for credit transactions when cash starts to move. If cash starts to move, then those credit transactions will become cash transactions. Okay, for example, when so-called D here was now paying, that's when the cash book came into perspective. However, when so-called D was taking goods from the business on a credit arrangement, the cash book was not in sight. Are we together? Because there was no cash movement. But when cash starts to move, then the cash book comes into play. All right. So transactions for so-called D and K, these ones, their sales tax elements were handled when the transactions were first entered into, not when the cash was now being paid. No, it doesn't work like that. When so-called D was was buying goods from us, that's when we charged the tax on him already some time ago. Not today, when we are now receiving his money. It will be now double accounting if we open another sales tax entry for him. I'm sure we are clear. It also applies to Masamba here. Masamba is not going to be having some tax connotations, because when we buy goods, when we bought goods from him some time ago, that's when they charged their sales tax on us. But now they can't do it anymore, because the transactions, the sales tax elements were already taken care of some time ago. All right, good. So only the cash purchases here have got some tax implications. And I said, if you are given this figure, which is got the gross, gross tax amounts, which is a gross tax amount, then to get the sales tax amount, you just have to multiply by 20 over 120. If the percentage was 15, you're just going to say 15 over 115. If it was 16%, you were just going to say 16 over 116 for you to get this sales tax element. So simple. Please don't be confused there. All right, much about this. Then you can see that there are these totals. All right, there are totals there. All right. In relation to the above analyzed cash book with sales tax, the introduction of sales tax alters the sales that are shaded. Assume that sales tax is 20%. On the debit side, cash sales of $399 were made, but some of these amounts are the sales tax and some the net. These have to be accounted for separately. Like I said, all right, the sales tax here is going to be accounted separately from the net cash sales. All right. Why? Because that's the requirement in most jurisdictions. The tax authorities, they want their tax to be clearly shown separate from the business money, because sales tax money is not the business money. That's the assumption. Okay, so cash of $300 plus 99 was received, and these amounts are in the total column of the cash book. So we have got the cash book showing these amounts, right? Is that it there? That's not it. That's not it. Let me just. Cash of 300 plus 99 was recorded, was received, and this amount are in the total column of the cash book. Okay, total column of the cash book. All right, we've got these 399. That's the total column of the cash book. All right. Then 332 plus, okay, that's 250 plus that one. The total of the cash sales column would be credit to the sales account. All right. All right. So here, that's not 399. That's 250 plus 82.5. 250 plus 82.5. That's 332.50. So this one was actually an error. 332.50. Okay. 332.50. Okay, and here, yeah, here that seems fine. All right. So the total of the cash sales column would be credit to the sales account. All right, and this one would be credit to the sales tax account. Remember, when we do sell, all right, in this case, these were cash transactions, so there was a debit cash, as you can see in the cash book there. All right, and then it was debit cash, right? Debit cash. But we need to say credit sales net, and then so we are going to have double credits here, okay? But by the end of the day, remember the double end, the cash amount paid, the actual amount received should also tally with the actual, with the net sales figure and the sales tax amount. So like here, the sales tax, okay, in this case the sales tax was from this information. We are simply just using these figures, okay? So that's the net sales in total were 332.5, and then the sales tax was 66.5. Okay, and then the total cash which was received was 300 plus 99. That's 399. All right, so you can also just try to cross-check with your calculator to see if these guys are going to balance. You can see that there is 399 here, and here there is that's 10, 2, 6, 8 plus 1, 9, and then 9, 9. So you can see that the double entry is actually correct. Our double entry there is correct. So there is no sales tax implication arising from the amounts received from Soko D and Abel. Okay, these are not new sales and are merely the old customers paying what they owe. We spoke about that. On the credit side, cash purchases of $361 were made and $361 was paid out. However, only $300.83 of this was the net purchases. The 60.17 was the sales tax on these purchases. So we are told that the total was 361 for the cash purchases as indicated. Let me just try again to rub it off here because the clutter might confuse somebody. All right, so that's the total amount that was paid. However, it included this as sales tax, and this one is the net amount of the purchases. Okay, so the double entry is what is being spoken about here. All right, well, we have got the credit cash. The cash was 361. The debits, we are going to have debit purchases, net, the net amount. Okay, also debits, the sales tax amount, and the amounts have already been calculated, where we are saying that there is this 60 and there is this is the net amount, which was 30.83, and then the sales tax amount was 60.17. If you add them, they should all come to 361. Here there is 361, to ensure that what you are doing is actually the correct thing. All right. Now, wages and tax are not subject to sales tax in most jurisdictions. Sales tax is only charged on some goods which are not zero rated. Okay, the payment to Masamba is not new purchases to the, so there's no sales tax implication. The payment is simply a settlement of what is owed. Okay, all right. But you might also say, hey, but I'm still confused because there is another tax there and you are only talking about sales tax, sales tax. What about this other tax? What is it? Okay, why is it appearing on the cash book and it is just a silent underdog? This one, this guy here. Isn't this subject to the sales tax column there? He was not put in the sales tax column, but he was put on some other far away column titled sundry expense. Yeah, this one is what you can call income tax, not sales tax. Income tax, which is levied on all activities where income is at play. Okay, when you make some income, you are going to be charged by the taxman on that income. So when you do business, you are going to pay some tax. There is a certain corporate percentage, usually in Zimbabwe at the moment is 24.5%. I mean, it's 24% only. It's 24%. Okay, the corporate tax, the ruling tax rate at the moment is 24% for business income. So this is where this tax paid was emanating from. It has nothing to do with the sales tax, but it is on income. All right. So the receivables ledger system is spoken there. Ladies and gentlemen, please revisit our previous lecture as well as this part for your deeper understanding. Then when it comes to documentation within the sales and receivables area, well, please just take note of these few things. When sales are made, invoices will be issued to customers. Whenever you make a sale, you then issue an invoice. Statements will be sent regularly to customers, setting out what is owed and what has been paid. So after you invoice customers, those who have taken your goods on credit, you then have to issue some regular statements, okay, to customers, so that you'll be explaining how much they owe and how much they have paid so far. Then those customers may issue remittance advices, okay, showing which invoices were being settled. Okay, whenever they want to pay, they also send remittance advices to inform us which invoices are they paying. All right, so that's it for now. Then let's talk of accounting for settlement discounts. Here we consider the application of IFRS 15. Remember, ladies and gentlemen, the word IFRS shouldn't scare us. Simply means International Financial Reporting Standards. This one is a standard D. Okay, International Financial Reporting Standard number 15, that is revenue from contracts with customers. Alright, so when we talk of settlement discounts or prompt payment discounts, we should be guided by IFRS 15. Remember, when we made some distinction between management accounting and financial accounting, we say that management accounting was not regulated, but when it comes to financial accounting, it is regulated. We have to follow international accounting standards, the Companies Act. There are so many rules that govern the game. Okay, so you're not going to be on your own. You are going to be directed by rules. Okay, so IFRS 15 considers there to be a 5-step approach when recognizing revenue. The first step is you have to identify the contract with the customer, all right, whether there is any contract or not. Otherwise, some of the business relationship might be having some, but they are not actually going to be considered as contracts. They fall short of being a contract. Okay, so there should be a contract first. Then identify. Remember, this contract can be verbal or written. Then there is also step number 2, identify the performance obligation in the contract. What is it we want to deliver? It should be very clear, that performance obligation which you have to satisfy. Then determine the transaction price. We need to determine the transaction price. Then allocate the transaction price to the performance obligation in the contract. Lastly, we have to recognize revenue when or as the entity satisfies the performance obligation. Now, for prompt payment discounts, these ones are offered to credit customers to encourage prompt payment of their account. It is not guaranteed that customers will take advantage of those prompt discounts, however attractive. Okay? Okay, let me just take a call. All right, hold on. Okay. So, it is not guaranteed that customers will take advantage of prompt payment discounts at the point of sale, as it is dependent upon whether or not the credit customer pays within the settlement window. Alright? In order to recognize revenue, an entity must determine the amount of the consideration it expects to be entitled to in accordance with the criteria of IFRS 15. Per IFRS 15, the third step to the 5-step approach requires an entity to determine the transaction price, which is the amount to which an entity expects to be entitled in exchange for the transfer of goods and services. When making this determination, an entity will consider past customer business practices. We need to know from previous history whether this particular customer has been paying or has been meeting stipulated times whenever he was servicing his account. All right. So sometimes using previous history or from the credit department or from the sales department, we may be told that this Mr. So-and-so usually pays right on time. When prompt payment discounts are offered, it means that the expected consideration is variable consideration, as the amount the entity will actually receive is dependent upon the customer's choice as to whether it will take advantage of the discount. Where a contract contains elements of variable consideration, the entity should estimate the amount of variable consideration to which it will be entitled under contract. If it's 15 deals with the uncertainty relating to variable consideration by limiting the amount of variable consideration that can be recognized. Specifically, variable consideration is only included in the transaction price if and to the extent that it is highly probable that its inclusion will not result in a significant revenue reversal in the future when the uncertainty has been subsequently resolved. When an entity enters into a sale with a customer and a prompt payment discount has been offered, the amount of revenue to be recognized initially will need to be estimated taking into account the probability of the discount being accepted. When the entity expects that the customer will accept the discount, revenue should be recorded net of the discount. So much of this, let us try to get into an example and see if we can we can make sense out of it, because usually if we continue rambling, somebody here might fall asleep. So I think let's just go through the example. Alright, you can just pause the video and try the example on your own. Alright. Irrecoverable sold goods with a list price of 2,000 on credit to a customer. Irrecoverable has a 30-day payment period and has offered the customer a 3% prompt payment discount if payment is made within 15 days. Based on past experience, the customer is expected to pay within 15 days and therefore will be entitled to the 3% discount. What accounting would be required to deal with this transaction in the following scenario? Okay, the customer pays within the 15-day payment period as expected. Then number 2, the customer pays after the 15-day settlement period. Now, we are having two situations here. The first one, this guy pays within the 15-day payment period and then after the payment period. Now, the initial sale will be recorded at the discounted amount of 1,940. That is 2,000 multiplied by 97%. Where did we get the 97%? 97% is 100 minus 3% settlement discount. If somebody is paying within 15 days, we are going to give them 3% discount. So in this case, this guy has made his payment within the 15 days. So he's entitled to 3%. So 100 minus 3% is equal to 97%. So 97% multiplied by 2,000 is going to give us this amount. Alright. So the entry that has to be made is debit receivables 1,940 and credit revenue 1,940. If this guy, this is on the date, okay, on the date when on the date when the customer enters into contract with us, okay, contract. That's the amount we are going to record, okay. So which means that in the sales day book, the amount that has been recorded was 1,940, okay. If the customer pays within the 15-day settlement period, the accounting entry would be the same. Debit, okay, we're going to debit cash because we are receiving cash, and credit receivables. Why are we crediting receivables? This is again a revision now. It is now a revision because we want to reduce the receivable. Remember, initially here we had debited the receivable. The first entry, our first entry, we had debited receivable and credited revenue. Revenue is also called the sales. We credited the sales. Okay? All right? Are we together? Initially, we had debited receivable and credited sales because we had sold goods on credit. But now, the receivable has paid, so we are receiving cash, debit cash, and credit receivable because we wanted to close the receivable. No more receivable. We have reduced the receivable. But if the customer pays after a 15-day period, okay, the company would instead record this as debit cash 2,000 because it's going to pay in full, no more discount. Okay, and credit receivables as usual because he has paid, so the receivable is going down. And we also credit sales because initially we had reduced this sale, we had reduced it because we thought he was going to pay in time. But because he did not pay in time, so he had to pay that other $60 which we had ruled off from him. All right. So if based on past experience, Railco did not expect the customer to make the payment within 50 days, then the full 2,000 would have been recorded as revenue in the first instance. So if we had doubts about Railco in the initial stages, we would have written or built this customer with 2,000. Okay, so our sales table was going to have the 2,000 endorsed. All right. If the payment was made within 50 days period, after all, this would require an adjustment to reduce its. So let's say if we were in doubt, we would have billed him as 2,000, but if he had paid within the 15-day period, then we would also give him the 3% still. Okay, he was also going to be entitled to the 3%. All right, that's it. So there is another example there, and you just have to go through it. It's just the same. Let us just talk of the irrecoverable debts and allowances. All right, there is credit control. Credit control is the name given to the process of trying to ensure that cash is eventually received for all credit sales. So we have, remember, we've got what are called internal control systems. Within companies, there should be some internal control system which will enable management to achieve its purpose. Okay, which will enable the business to achieve its purpose. For example, we might be having a security guard at the door. We might be having good quality staff, good customer care. Security cameras, safety, health and safety control systems. Everything interact within the company. There is also what is called the credit control. This would assist managers or the company itself to ensure that cash is eventually received from credit sales. Okay, sometimes you offer credit facilities to people, but they abuse them. They just take your goods and go away forever. The process starts with a new customer applying for a credit, and this should initiate some investigation, such as asking for the applicant's recent financial statements, inquiries to a credit reference agent to see if the applicant has any history of poor payments. You need to actually investigate, to hire some professional investigators, some credit agency to help you to some extent. Okay, but you just have to also take heed because some of those people might actually abuse your customers or harass them. All right, so just have to be very careful, because in this dynamic business world, just have to be very careful with whatever step you take. Sometimes you might kick yourself out of business. Now, based on this investigation, the applicant will be accepted or rejected. A credit limit should be set for all customers. Once the credit sales have been made, each customer should be encouraged to pay according to the terms of the contract. There are three ways of proceeding. Send statements. These often act as gentle reminders about what's due. Settlement discount for the purpose. For example, pay 5% less if paid within 30 days. Prepare aged receivables analysis and act accordingly on the information contained there. All right. Okay, that's much of the reading. Now, irrecoverable debts and allowances. Now, after you did everything about the credit control, you have approved somebody and they took your goods and they went away. There is now an issue of having some people who are called irrecoverable because they can't pay you now, or they are now trying to vanish into thin air. In this part of the slide, we'll consider what a company should do in the situation where an accounts receivable does not pay his debt, or where there is some doubt about the eventual payment of all or part of their debt. We will examine both the accounting entries and the presentation in the financial statements. An irrecoverable debt is where we are reasonably certain that the receivable is not going to pay. For example, the customer may have died, leaving no asset, or may have disappeared without trace. Then we have got somebody called a doubtful debt. This is where we are worried that the receivable might not pay. For example, the debt might have been outstanding for some time and the customer may not be replying to the letters sent from us. Note that obviously if a customer refuses to pay, we are at liberty to take them to court. However, it may be that the cost of going to court will be more than the amount of the debt, and that therefore we decide not to do so. So sometimes it is better to just keep on pestering than just try to take them to court, considering the value involved. Okay, treatment in the financial statement. It is important that we do not overstate assets in the statement of financial position, that we apply prudent conduct, that we therefore should only show the receivables that we feel confident will pay. Equally, if we realize that we might not receive payment, therefore lose money, we should show this as an expense in the statement of profit or loss as a doubtful, as any doubt arises. As a result, the treatment is as follows. It is irrecoverable debts. These are removed completely and will no longer appear as part of accounts receivable. Then, doubtful debts. We will leave the debt outstanding as part of accounts receivable because we are still trying to collect the money, but we will deduct from the receivables an allowance for receivables equal to the amount of any doubtful ones, so that the net figure left in the statement of financial position is the total receivables for which we foresee no problem. Okay, specific allowance for receivables. This is an allowance for particular or specific debts where we know that there is a problem. For example, the debt has been owing for a long time. Alright, these are actual amounts. Okay, then general allowance for receivables. It may be that in our company, it is the nature of the business that on average 5% of our debtors end up not paying. However, it may be that at the year end all of the individual debts are reasonably recent and we have no way of identifying which particular customers will end up not paying. We do feel, however, that probably 5% of them will not pay. Again, to be prudent, we will deduct 5% from the receivables to leave only the amount we are reasonably certain of. As this 5% does not relate to any specific customer, we call it a general allowance for receivables. In all cases, the cost of removing irrecoverable debt and of allowing for doubtful debt is charged as an expense in the statement of profit or loss. So when we're talking of specific allowances, these are actually certain amounts. But here, these ones are actually relational. relational or relative. Okay. All right. Let us just go through an example. All right. At the end of the first year of trading, there is a balance on the receivables account of this company, right? All right. All right. Okay, so we are now going to do this example together. Okay, example A. At the end of the first year of trading, there is a balance on the receivables account of credit of 62,500. Upon investigation, this amount is found to include two debts from A PLC and B PLC, which are to be regarded as irrecoverable. The amounts owing are 2,500 and 1,600 respectively. In addition, there is $2,800 owing from ZPOC, which is regarded as doubtful. CRED has a policy of maintaining a general allowance for receivables of 4%. Show extracts from the statement of financial position and statement of profit or loss of CRED. Okay. Okay, so here we go. All right. What's going on with my pen? Good. All right. So we can just start with the workings. All right. Let's determine the receivables. Okay, this is our working number one, receivables. We're given this total figure. Receivable. That's 62,500. Right, but we have to deduct these ones which have already been considered irrecoverable. So you can just say less 2,500 and 1,600, which gives us 4,100. All right. And 0, 0, 4, 12, 8, 0, 0, 4, 8. So that's 58,400. All right. So that's the receivable figure there. All right, and let's determine the allowance for receivables. Allowance for receivables. We have got the specific allowance. Specific, this one can be easily identified as this one. It's 2,800, because we know that Mr. Z is actually doubtful, so that's a doubtful receivable. Then we need to compute the general one. We are given the 4% general allowance, multiply by the figure we calculated above, 58,400. All right. Minus this 2.8 because we do not want to double account it. Right, so if you punch these figures in our calculator, you just have to get 2,224. All right. So you add up, must get 5024. All right. So the first information which we need. Then I have to use those figures to slot them into the two statements. Can start with the statement of financial position. Okay, position. Right. Receivables are current assets, so this is just an extract. It's not the full statement. So the current assets. We've got receivables. Can just say working number 1 because we obtained this figure 58,400. Alright, then you deduct the allowance. Allowances for receivables, that is working number 2. The working number 2, how much did we get? That was 5,024. Alright, so this should be the adjusted figure for receivables. Okay, now in the statement of profit or loss, receivables, I mean those irrecoverable debts or irrecoverable receivables, those ones are an expense, so they are under the expenses section. We have got irrecoverable debts, and we know those ones, the 4.1. All right. We also have increase in allowance for receivables. That is 5024. Okay. Why have we referred to this as increase? Because it was actually an increase. We had no information about whether the previous year there were such dates, okay, which were a bit higher than these ones, okay. So there was actually an increase. All right, so we then have to total up, and we get 9,124. All right, so in the statement of profit or loss, this is going to be shown, and in the statement of financial position, this is what we are going to see as our receivables. Okay. Now, accounting entries. In each individual entry that can be required, is Very easy. The problem in the examination results from the fact that there can be many accounting entries required in a question, and it is easy to get lost. Alright, so let us then go through examples B and C to determine how we are going to get around that. Okay, we've got problem B there, which talks about sealer. We started business on 1 January 2000. As at 31st December 2000, the balance on a receivables account was 82,000. That was the balance for sealer. Alright. On investigation, this was found to include the following debts, where we have got Mr. John, who owed 5,000, which is irrecoverable. George owed 8,000 and is a doubtful debt. Paul owed 3,000, which is irrecoverable. Anne owed 2,000 and is a doubtful debt. In addition, it had been decided to have a general allowance for receivables of 4% of remaining debts. Write up the accounts receivable, irrecoverable debts expense, and allowance for receivables accounts. Then show extracts from sealer's statement of financial position and statement of profit or loss. So we can quickly do this by starting with the workings as usual. So all workings, okay, can just say one computation for allowance for receivables. Alright, so we've got the specific as usual. The specific can go here, go back here. These ones which are tagged doubtful, it's a specific one, and this one again, which is doubtful. Okay, so that's 8,000 plus 2,000. Right, and we get 10,000. We have got the general one, and what is the percentage? The percentage is 4%. 4% multiplied by the figure we were given there. We are told that there is 82,000, okay, receivables in total, but are we going to use the 82,000? Obviously, that's not going to be, because we are also told that there was 82,000, okay, but 5,000 is irrecoverable, this one, and there is also this one. These guys are not going to be recoverable, so we are going to have 74,000. Going to have 74,000. These ones are not going to be recoverable, so we can't ignore them. 74,000. All right, and we also need to consider some other guys here. We just have to consider some other guys. All right. The issue to worry about here is to prevent the double accounting, okay? Because we have to remove these specific datas, okay, the doubtful ones. So we have to remove them. The 10,000 here, they have to be removed from the 74, all right? And after doing that, then you have to punch these figures in your calculator, and obviously you must get 2,560, and then you total up, you get 12,560. Then once you did this one, you then have to do your proper recording. For example, the receivables account, receivables account. The account receivable is shown like this. Remember, the receivables are assets, so obviously we're going to have the balance BD being on the debit side, and we are going to say 82,000 here because we started with 82,000 according to the question here. There was 82,000, all right, and then we are told that some of these were irrecoverable, so those irrecoverable are going to be on the credit side. Irrecoverable, those on the those irrecoverable are going to be on the credit side, and these were 8,000 in total. We computed them here. We discovered that they were 5,000 plus 3,000. They were in total 8,000 here. That's 8,000. Okay. So the balance for these 82,000. So the balance should be 74,000. Okay, and this is the same balance as you can see here. All right. You may also want to show the recording of the allowance for receivables. Okay, which is also coverable debt. Okay, coverable debt there. Okay, for the allowance for receivables, we've already calculated this figure, so you can just slot the figure into our T account here. So that's this one. Now, the last one is the irrecoverable date. Okay, the irrecoverable date expense account. Okay, irrecoverable date expense. This one again can draw a T account, and we know an expense is increased by debiting. So when we were having irrecoverable debts, they were increasing this account. So all the receivables which were being irrecoverable have to be considered on the debt side. There was a 5,000 for there was this John and Paul, the 3,000, 5,000 and 3,000. Okay, receivable Paul, 3,000. All right, and also the allowance receivable, allowance for receivables, of 12,560. This one, remember this one. Okay, 12,560. So we then have to add them up. We get our 20,560. Okay, 20,560. All right, and we then have to total up. Remember, all these have to be transferred to a certain account called the statement of profit or loss. Okay, statement of profit or loss, the SPL, and everything goes there. Alright, so we have done our part there. How you were supposed to have, how you're supposed to deal with the record keeping aspects on these doubtful debts. Alright, so if you are confused anyway, just have to listen, replay the video and until it sunk in your head. Alright, so let's do the last part and then we call it a day. Alright, during the year ended 31st December 2021, Sila had made sales on credit of 261,000 and it received cash from customers of 238,000. These amounts had been entered into the receivables account and a balance extracted. On investigation, the following was discovered. Paul had paid 2,200 of his previously irrecoverable debt. We do not expect to receive any more. Okay, we didn't expect to receive this. Then George had still not paid the 8,000 owing and must now be recorded as irrecoverable. Alright, Anne had paid her debt of 2,000 in full. Ringo was owing 4,000, which is recoverable. Mick was owing 6,000 and is a doubtful debt. If it was decided to maintain the general allowance for receivables at 4% of the remaining debts, note the amounts received from Paul and Anne are included in the total cash receipts for the year of 238,000. Write up the accounts receivable, recoverable expense, and allowance for receivables accounts, and show extracts from Silo's statement of financial position, statement of profit and loss. Alright, so we simply do what we did before. Okay, the very first thing you can do is just to come up with some bit of working. Okay, some bit of working, because working is actually really good. Okay, let's calculate the allowance here. Alright, calculation of allowance. That's the first working of allowance for receivables. Allowance for receivables. Okay, we are having we start with the specific. Specific is those ones which are clearly identified as doubtful. For example, this one. Yes, do we have another one? Cover reported. This one. Okay, this one has been recovered and still not paid and must now be included as recoverable. Okay. So there's only Mickey who has been doubtful, so that's a specific one. Mickey's doubtful, so that's 6,000 doubtful. And then let's add the general. We have got 4% multiplied by. We are told that there has been some okay, so we need to determine the general allowance after taking into consideration events which occurred so far. So we need to know the actual balance brought forward for the receivables. So we had, from the previous computations we did, we determined that the closing receivable was 74,000, as you can see here. Alright, so that was the closing balance. Alright, but we need now to see if we can make something out of that. So we have got our information here. So let us just have a receivables account here. The balance BD was 74,000. Okay. Now we are also told that we made credit sales of 261,000. So sales, all right, 261,000. All right, and then these sales were paid for. All right, so some customers, the customers paid. So cash 238 was paid. All right, cash 238. Why is it on the credit side of the receivable? Because we want to reduce the receivable, because these were payments. Remember, the receivable is a debt balance. All right, whenever we sell goods on credit, we record the receivables on the debt side of the receivables account, because the receivable is an asset. But when people now pay, it is being reduced on the credit side. So this is why we put the 238 on the credit side. Okay, and then we just have to add up. Okay, let us just add up. So this, if we add the 0, 0, 0, 5 there. Okay, there's the 5, there's the 13, there is a 3. So this 3, 3, 5. Okay, so what is the balance? The balance should be, if you use your calculator, let me just see here. That's 97,000. Okay, so we take this one down there. So it becomes the balance PD again, 97,000. Then we are told now that along the way, Paul had paid 2,200 of his previously irrecoverable debt. So some debt which was considered irrecoverable was recovered now. So irrecoverable was recovered, 2,200. All right, and then George had still not paid 8,000, and this one is now being considered irrecoverable. So as we did before, this one recoverable is reducing our receivable, so we put it on the credit side, and that's 8,000. Okay, then there is also this one, so we do this one. Then there is also these guys, the 4,000 for Ringo is also irrecoverable. Coverable 4,000. All right, so we do the same. We'll just add up because there are no other entries there. Okay, N is paid up. Choose 2,000. We'll do with that. Right, we'll do that. All right. So if we balance up, we then have to say 0, 0, 2, 9, 9, 99, 9 to 100. Okay, so balance balance we have here is going to be some 87,200. Okay, that's the balance we have. So we are going to have this balance as the balance which we need now, because the 87,200 is going to be needed, but less the 6,000, because 6,000, to be said, it's a specific allowance here. This 6,000, you just have to remove it here to avoid double accounting. And so if we say 87,200 minus 6,000 multiplied by 4%, we must get this figure here as 3,248. All right, and we then have to add these figures to come to 9,248. But remember, we had a balance outstanding on this allowance. There was this figure here when we computed in the previous example, P12560. They were initially, the allowance was 12,560. Okay, initially. Okay, balance PD 12,500 and excuse me. All right, so then I have to get the difference, and this difference is what is called, we call a decrease, because we have decreased from 12,560 to 9,240. So the difference is 3,312. This is what is called decrease in allowance for receivable. So a decrease in allowance, is it a loss or a gain? Obviously, some gain of some sort. Okay, so let us draw the other accounts outstanding here. You can draw those accounts outstanding. All right, allowance for receivables. Allowance for receivables. Okay, it's a T account as usual. On the debit side, we've got irrecoverable debts, and we have determined the value as this one, 3,312. 3,312. Okay. And then on the credit side, we've got the balance brought forward, which was 12,560. All right. And then we just have to balance up 12,560. So this is the side that needs the balance 9,248. All right. All right. Now, which account is not being covered here? I'm sure we also need this other account here, the irrecoverable cover. Recoverable. Recoverable debts expense. The recoverable debts expense, we also come up with a T account. Okay, and this T account should actually B, authoritative, that is the receivables. All right, the receivables amount which we are talking about here are those ones which have been declared irrecoverable. There is 8,000 for this guy here, the George. George has been considered irrecoverable in the circumstances. Okay, George 8,000. There is also this other guy, Ringer. Okay, so receivable again, Ringer, that's 4,000. All right, that's 4,000. Then there is also a recoverable one. All right, so he's on the debit, on the credit. This guy is reducing this expense, the 2,200. Remember the guy who once was considered irrecoverable, the poor guy. Paul was once some time ago considered irrecoverable, but out of the blue he came and paid his dues, so that was a bonus. So the allowance which we calculated, there was a reduction in the allowance, remember, and this is going to be again on the credit, the allowance reduction. Remember, initially the allowance was supposed to be on the debit side of this account. Remember here, initially on example B, okay, because this was an increase in allowance, but in this case this is now a decrease, and this is why you see it on the entry is actually on the other side, on the credit side, as you can see there. All right, so we then have to balance up the accounts, and the larger side is this one, having out 12,000 there, 12,000 there. So the balance to be sent to the statement of profit or loss, the charge, is now going to be 6,488. Thus, the statement of profit or loss charge, ladies and gentlemen. All right, and our allowance for receivables is going to have this balance as the amount to stay there. Okay, I think that is that. We are done with this topic, and we just need to continue practicing, because without practice we are not going to go anywhere. Okay, we are not going to get anywhere, so we need just to practice. So in summary, when we are talking of irrecoverable debts, these are amounts that the business will not receive from its customers. All right, irrecoverable debts. These are amounts not not to be received from the customers, They are they're not going to be received because the customers could be either in bankruptcy, or it could be due to fraud by the customer himself, or some disputes where the customer is saying that I do not agree with your figures. All right. Now, what about the allowance for receivables? All right. There may be some doubt as to the collectability of some of the business receivables balances. An allowance is therefore made to recognize the possible expense of not receiving the cash. All right. So that will be some prudence. All right. Now, accounting for the irrecoverable debts. To recognize the expense in the income statement, we then have to debit irrecoverable debt. Okay, expense, and credit accounts receivable. Why? Because we want to reduce the accounts receivable, because some of those accounts, the receivables are not going to pay. Okay, what about accounting for irrecoverable debt recovered? When we recover an irrecoverable debt, we debit cash because we are receiving cash, and then we credit irrecoverable debt expense. Why are we crediting an expense? Because we want to reduce an expense. Right? It's no longer an expense anymore. We are reducing it. Okay, and then we debit cash. What about accounting for the allowance receivables? To record an increase or settling up the allowance, we then have to debit irrecoverable debts expense and credit allowance for receivables. The journal entry is reversed if the allowance is reduced. So that is that, ladies and gentlemen. I hope you will be fine with this video. I know it's a bit challenging, but with practice, everything is made perfect. Okay? With practice, everything is made perfect. Until we meet again, ladies and gentlemen, may the good Lord be on our side, and may His countenance shine upon us. Ladies and gentlemen, if you have found this video very helpful, don't forget to share with your friends, to subscribe, to click the notification button, and also to make some comments which are so encouraging, so that we all improve as we go. Until we meet again, once again, ladies and gentlemen, may the good Lord bless you. Goodbye.